Good morning, everybody. It is Tuesday, July 28th, and we are going to go through our plug and play stock portfolio models. And I just want to talk a little bit about how I selected stocks, um, that they won't be there forever, uh, and that there's certain ways to evaluate these that I think stand above all the others. So in doing this, I put together both a growth list and a dividend list. And then the retirement income options is just a combination of those two lists that you can balance however you want. And we'll talk about that in the next webinar. I'm actually going to record twice here. I'm going to talk about the growth stocks first. We'll pause, take some questions, and then we'll do the dividend stocks. And then we're going to do an options portion. So we're going to be online here for an hour and a half. But I'm going to break it up into 3 different portions so that you can watch what you want to watch. We're going to start with the growth stocks. And I just wanted to say that when I look at a stock, and this is always what I look at, and when you hear me talk about stocks, I usually talk about something that I think the market is missing, that it will recognize soon. And this is stolen from people like, Warren Buffett and Peter Lynch. The secret to investing well is to place value on a corporate asset or value on future growth that the rest of the market doesn't recognize just yet. And because the markets are pretty rational and transparent, and the supercomputers do a lot of the work now, it is hard to find bargains just by looking at numbers. So when you hear me rip on authors across the universe of investment bloggers and investment letter people and even investment analysts, I rip on them because they just look at the numbers that are there and they say, well, this one's going to be worth 12% more, 20% more. You know what? Those little prognostications aren't really analyzing anything, in my opinion. I think you need to look at the corporate documents. You need to truly learn a business and understand what it is they do. So when you don't hear from me for 2 or 3 days, except for little blurbs here and there, it's because I'm reading, and I read a lot. I'm sure I read the equivalent of a book a day. And I am looking for things that the market doesn't understand. And of course, I start with my screeners, and I will tell you, pretty much everything that I found here came from Stock Rover and bar charts. And between the two of them, I'd say that bar charts is a little bit better at helping me finding the winners and losers, and Stock Rover is better at helping me sort out and monitor the fundamental data. I don't think it's a bad idea to have both of these. I don't have any particular code for bar chart. Just sign up whenever they run a special. And Stock Rover, I have a code for that on both websites, and I'll put it on this YouTube video. But the reports that you get from these guys are just pretty amazing. So when I pull up my watch list, and I want to see a quick report on a company, I mean, they've got it. And these reports are awfully good. I mean, why would you ever need to read a hard to keep organized article on Seeking Alpha or investing.com or anywhere else when you can get all the data right here, right? The trick for you is to learn how to interpret this data, which is what I keep trying to do. The plug and play portfolios, though, are a way for me to give you what I think the best ideas are for the coming quarter. These are companies that I think have value that's not recognized yet, that are already either near a pivot point to the upside or just starting to trend to the upside, and aren't horribly overvalued. In looking at the market right now, I will tell you, chart after chart after chart has just gone parabolic straight up. and this is expanded into the small cap and mid cap universe, some of the charts don't make any sense at all. Now we can just pick one at random. I don't even know who some of these companies are. But if we go here, look at performance and rank by 6-month change. I mean, look at some of these charts. So here's a company whose earnings have gone down, Kodak. But look at the chart, it went straight up. Why? Because they had some stupid little report the other day, yesterday maybe, and the chart went straight up. Look, it went from 2 to 10. Tell me that sort of thing makes sense. Was the market really so ignorant of whatever was going on over at Kodak that it should jump 400 or 500%? You know, I just don't understand why people think that this is reasonable. So while the markets are usually rational, if you run into situations where it's irrational, you ought to be looking, you know, at the people who bid this up kind of funny. And there's chart after chart after chart like this. I mean, I just pick one at random. I'll pick the one that pops up right here. There, Harmony Gold. From 2 up almost 350% in 3 months. Okay, when was the market stupid? When it was trading in this range, or when it went straight up? The market had to be stupid one of those times, right? So in chart after chart after chart, we're seeing this breakout that is monumental. And you can even pull it out, I mean, on 5-year charts, which you should always be using a 5-year chart at least. See the breakouts here. So when was the market rational? Range bound on a stock with no earnings, or straight up because the price of gold went up? And now maybe they'll earn a dime. So anyway, I look at this over and over and over again, and I'm seeing all these charts. So it's hard to pick out stocks that we want to invest in soon. But I got it down to about 20 stocks. So the growth stocks, sustainable growth of some sort, doesn't always mean ESG or alternative energy. It just means that the growth is going to continue. And I use the word sustainable because, yeah, it's kind of a marketing word with the whole green energy and ESG movement. Primary focus is on growth that buy and holders could own for years. So these aren't trading stocks per se. I mean, you can trade anything, but I'm looking for stocks that are close enough to a buy point that if we get to the buy point, you could buy these stocks and probably hold them for years if that's your approach to investing. And I think that most core investments ought to stay for years. And then you trade around the edges, generally using options. So I think it's interesting that, and I just alphabetized these, the stock at the top of my list is Alibaba. You know I don't like Chinese stocks, and there it is, number 1. That's not really number 1. It's just alphabetical order. So by virtue of starting with an A, they got to the top of the list. And so what we want to do is take a look at where the buy zone is. So this one's already in the very short list. Alibaba right here. And I've been taking away these colors because A, it's a pain in the butt, and B, you've got the plug and play to look at. So here we go. Have the chart. Pop it out. And what we see is that Alibaba has done so well that you probably can start buying it right around $200 a share, 209, probably the very top end of the buy range. You have a base fib level, a 0. Zeros and ones are important. And so are those 0.618s. And we were talking about that earlier, that we just keep seeing 0.618s and 0.5s happening over and over again. So, I mean, I guess there's a possibility that in a mega crash, Alibaba goes way down in here. I will tell you, I would be pretty surprised if Alibaba gets below 200 again, unless there's just a huge crash in China. The growth of the cloud in China is so massive that I think you just have to buy this, right? This line was resistance twice. It broke through. It'll probably retest. So right around 210, I think you buy Alibaba because I think it's going to grow like Amazon. So wouldn't you have liked to buy Amazon at $200 a share or $220 a share? And I don't think it really should break your heart even if you buy it up here at 227, right? Because this is an R618 level. And in reality, I think it's probably smart that we move that buy box up to here, right? It's a 618 level. We know these things get hit. It did represent a new level of resistance that it broke through. Should retest. But this area in here, the top of this buy range, is probably where I think you start to buy if there's not a big double dip recession. If there's a big double dip recession, then I think you let these other levels come into play. All right. So that's the sort of thing that I want you to think about, is different scenarios. That could happen. And oops, don't mess up. Always gotta do this over on the master list. Or Dimitri yells at me. I'm just kidding. Dimitri never yells at me. He actually made a little video so that today, because I was doing something wrong over and over again, he did a little video for me. He said, look, this is how you do it. So now the VSLs are working pretty good. Because there's so many of you on from time to time, it takes a while to load. So when you look up here and you see 37 people on, that's why it takes a long time to load. We're working on a different crypto tracker. This one stopped working. I think I have to buy something. I really only want to trade about 10 current, or track about 10 or 12 cryptos anyway. But as far as the VSL goes, a lot of updates. The yellow is what you might want to take a quick look at. I added substantial number of stocks this quarter because I think there's a lot of rebound possibilities. And I think there's a lot more trading stocks on the biotech side that ultimately I think you could short. So I started a short opportunities list. These are the 3 that I think that you can short. Interestingly, Arcturus is the #1 holding in the ARC Genome Fund, and I think that they bid this up. I don't think it's a horrible company, and I really don't think it's going back to 3. So we have to figure out where this one's going to go. But I think it's in, here's another one of those parabolic charts. So if you're Kathy Wood over at ARC and you're thinking to yourself, I've crushed the markets this year, I better lock some profits in. She is a disproportionate holder of this stock. I think when she takes her profits, it goes down to 40-ish, multiple lines here, could even go down to 30-ish, or even the lower 20s. And probably this red box should be moved up. I haven't looked at these options yet. But But weirdly, I think this is a stock that if you're a trader, I think you can short it. And then I think you could probably buy it back. So you could probably flip this position. If you can figure out when to short it, RSI is overbought, but not horribly. Money flow is overbought and looks like it might be tipping. And shaken money flow already showing the negative divergence. Stock price going up, money flow going down. And the MACD, the big Mac Daddy D, still heading up. So I think we're closing in on top, but until this turns, I don't think we're there yet. So somewhere up here, or maybe it blasts off like a rocket ship all the way up here, who knows? But at some point, these indicators should tell you about when this rally is done, and it has a long way to come down because this doesn't make any sense based on they don't have any earnings, really to speak of. So when you go to look at the rest of the stocks, what am I looking at with all of these? Calix, remember 2 years ago I told you about this company that if they could catch on with the 5G deployments, they do really well with earnings. They started to earn money. I think the stock is too high right now. I think that we have to let it come back to us. There's a lot more 5G build out to do, just judging from what I've seen in the United States. So again, this just doesn't make sense, right? I mean, when was the market rational? Is this irrational and this is rational, or the other way around? Well, let's keep in mind smart money, dumb money index. Retail has been pounding in, just started to turn over, and the smart money had been trailing out, had been selling to the smart, the dumb money has been buying from the smart money. When does that ever work out well? So with Calix, I think we let it come back to us. This is a pretty important level up here. So between here and in here, we need to evaluate what we think their future earnings are going to look like. And I think this stock can go all the way back down in here. Test these levels. Yeah, I don't think this is a very important support level, to be honest with you. I think that this rally here is more important. And was it going to keep going? Probably. There's probably like an S-curve going to level off. So in here, I think is where we have to be aware of what the future looks like for Calix. But they're becoming profitable, and people love the 5G story, and they've had a really good run here the last couple of years. I mean, even starting way back here, when we first started talking about this around $5, it's a heck of a run. CRISPR Therapeutics, DNA therapy, gene editing. Dynavax is a new name for us, and they have multiple partnerships on vaccines. So this is a way to get in on multiple different vaccines, and the stock isn't overvalued yet because they haven't been a headline grabber. But they've got 3 or 4 partnerships, so they could end up getting some royalties using their I don't know, the thing that you put the virus on, recombinant, something like that. It's easier for me to say the words if I could see them. But Dynavax is a play on multiple angles. I like it a lot. Somebody that I trust put me onto this one, and I don't, think you want to have a ton of any of these, right? 1, 2, 3, 4%. but it's got home run potential. And ultimately, all the stocks on this list have home run potential, right? That's not what the dividend list is for. But all of these, you're looking at doubles, triples, quadruples, I think, over the balance of the decade, if you get in at the right price. Electronic Arts. I know that this hasn't been the one that did the best out of the games, but I like the sports franchises. I think that the sports games, which are cyclical, I think as a new generation of sports stars emerges, you see these take off again. Electronic Arts, you could do a basket of several of these companies or use the ETF. I don't think that hurts you, but I do like this business in general. Ford, I've talked to you about what I think their opportunity is. I think their opportunity is to be a major thorn in Tesla's side. They have the built-in client base, generations of loyalty. That EV, the Mach 3, is a dynamite car. It's right there with the Model Y. I think that it needs some improvements, but I think in the second model they'll conquer a lot of that. The difference in technology between Tesla and the pack has been narrowing, not widening, despite what Tesla stock has done. So the most popular car in America is F-150, and that's going EV in 2022. And it'll probably be exclusively EV by 2025. So Ford's CEO already and the chairman already said it's too hard to straddle both sides of the fence, new and old. This company is going to go hard into EVs. And here's the kicker. Here's the thing that I don't think people value at all. We know that Ford transformed one of their plants because they are a fourth industrial revolution leader, one of only about 50 or 60 companies on the planet that have really put a lot of money into the automation and machine learning so far. And they're right there. They are one of the most important AI machine learning companies out there. And they have all these factories all over the country and all over the world. If you take a look at their operations map, they're going to close a lot of those and sell some. But a lot of them are going to be converted into other industries. I'm telling you right now, Ford is going to get revenue not only from being a big deal in EVs, but they are going to be a defense contractor, and they're going to do consumer and healthcare goods like they already did, right? They already converted one plant. I don't think that plant ever goes back to making cars, ever. So I think that Ford has an advantage here that is going to be hard to duplicate. It's just a unique situation. Their management's been that good for that long that they've been able to get through this whole transition. Granted, the financial crisis hurt them, and the spike before the financial crisis probably didn't make sense. So where was the market rational? The market was probably rational right in this area. And now it's going to go back into that area. And then I think as they expand their business lines over the next several years, I think you see big growth. So will they bring back their dividend? Yeah, I don't think until the second half of the decade. But can you imagine what happens if they bring back their dividend sooner than people expect? What happens if they become a big deal in aerospace and defense? What happens if they become one of the companies that lead all the reusable medical supplies that we need? I think a lot of those things are likely to happen. So Ford is on my list. It is one of my absolute favorites. And you're just going to have to deal with the volatility for a while. Invitae, another biotech. It was hard for me to pick out biotechs. I looked for companies that had multiple avenues of business. So CRISPR, Dynavax, Invitae, all companies that I think you can do pretty well with, but they're volatile. So you have to be careful on your entries. Itron, you know the story here. They bought a company that I was already invested in, Silver Spring, and they're going to have to do a lot with the automation of the cities and utilities. Landstars, transportation, logistics, it's just a dynamite business. We need to save these as we go. On Track, it's a lot like Teladoc, except that they have a diagnostic AI as part of their system. I heard about these guys at the Consumer Electronics Show. I think they're going to be a big deal. I have the chart up already. So, you know, it took them a while to get rolling. Here is the hope, the crash, slope of enlightenment, right? That is, this chart is what happens in technology. This is the Gartner chart, right? Hype, despair, disillusionment starts to build. Now, I think that this spike in here, probably a little too much, but I think we know that this industry is going in this direction, right? So I want you to try to figure out a way to own this one if you're a growth investor. I think you can trade it a little bit if you want to. But I think on the bear market that's coming, and I'm telling you, there's a bear market coming. We get this in this yellow box. Not only can we buy it, but early next year maybe, or maybe at the very end of this year, we can maybe even buy calls. So I think that you get this one on the pullback. I think the trend is clearly up. They're an asset-light company, right? They're not making widgets. They can just drop tons of revenue to the bottom line. So I like this stock a lot. And it's not grotesquely overvalued, even though it had this spike. And we get this down 20-ish. You know, I mean, I guess we could get it in here, but look at all the 618s and 0.5s here. I think 20-ish, low 20s, we probably get that one. PTC, automation, Pulte home builders. They're not there yet. I haven't even built the chart, so I want to show you how cyclical home builders are. It's one of the things I wanted to do today, right? Massive spikes. Oops, sorry about that. So let's go here and take a look at some of these massive moves. Where would you argue that the inflection point is? Way back here in the early 90s? Or do you take this bear market and go here? I think that that's the important inflection point. That's where it really starts to move up. And then the cycle gets crushed. With the financial crisis, right? So you go up here, and it extends all the way down here. So it round trips, right? Just a round trip. The longest reach extension is always the pink. The longest retrace is always the green. Second one's blue. I will do that little map article for you. Comes up here, not quite as high. But you'll see that the extension to the downside wasn't as great either. It doesn't round trip like it did before. Why? No financial crisis, which I think is a misnomer. I think we are having a financial crisis. They're just prevailing. Eventually, valuations matter. And when they matter, they'll matter a lot. So where do we want to buy Pulte? I don't know. But I think that this huge confluence here is a big deal. And I think that these 0.5s right in here are a big deal. Wow. Does that mean that it couldn't stop at all this confluence here? It could. I just don't think that's enough value for me to want it. Right? Doesn't mean that it wouldn't go up from there. It's just, I think it's too risky. But I think this area here, let's change this to a weekly chart. Make sure our lines are pretty accurate. They look good there. Look good there, look good there. Okay. So between now and next fall, and why do I say next fall? I think you better have some patience. We don't know yet when this bear market comes back and how bad it gets. But based on what they're talking about with unemployment benefits, I've been telling you for a long time, when people have to cash in their 401ks, the market will get destroyed. Just like it did in here. And then they won't be able to build houses because they won't have the money. So I think there's a really good pullback coming here, and I think it's this year. I'm going to want to buy Pulte because they're in good shape financially. So they pull back down here. I think that it's a buy. I'm in the 20s somewhere. But then I think the rally could be spectacular and long-lived. And in fact, let's make it a little easier to see. There we go. I mean, this is a stock, it could clearly go up here into the 60s. But from 44, it's not that big of a deal, and there's a lot of risk. From 24, right, not a lot of risk, unless we have Armageddon, right? So that's what I'm looking at when I'm picking these out. Pulte. What are they? Consumer discretionary. So this is what I'm doing today is the rest of these charts. Roku, you know all about them. SolarEdge is closing the gap on Enphase. I don't dislike Enphase. I just think they're overvalued. And like I said, I'm not positive I like the level of transparency from the management. And that's enough for me to say I can look at other things. It doesn't mean that Enphase won't go up. It just means I'm uncomfortable with it at the moment. They need to assuage my fears. Square, I love. SunPower, I love. Remember, what does the market maybe not value on some of these stocks? With Roku, is that they can get into the advertising as big tech gets regulated. So, and they have a good platform for doing it. I think that most TVs will have Roku built in the future. Not most, at least half, around half. Solar Edge, they play well with utilities, but remember I've talked about commercial installations for solar? Their inverters are fine for that, right? Because they're not, the slanted roof of a residential home. And we know that about half of the residents in America can't take solar anyway. So Solar Edge, I think, is going to do very well on top of flat box stores. Going to do very well. Or buildings that have some curves, right? If towers start to put solar between floors, right? Not below the windows or above the windows. Square, if cryptocurrency makes a difference and they start getting into international transfers even more, Square just has a world of upside. And then small business will come back. SunPower, backed by Total. And I'm telling you, you want to buy some shares because the spinoffs can be a good company. Sunrun, think about their partnership with Costco. Next year, if Biden wins, think about the solar incentives that'll be out there and Costco talking to every person that walks in and out of that store. Well, hey, have you thought about solar? Well, why don't you at least check it out? And by the way, you get your points if you buy it through Costco, right? I buy a lot of stuff at Costco or Amazon because I love the point systems. Travel Center America, I've talked about this one for a couple of years. I'm finally adding it to the list. I think that their transition is going to go very well. And if you are paying attention, you're noticing that people aren't flying as much, and I think that that's going to last. I think the drive across America is back. And I think it's back for an entire generation because having millennial children, young millennials, and all my baseball player buddies who are older millennials, I tell you what, the drive cross country, more and more people doing it. 10, 15 years ago, when I was doing it, people were like, why would you drive to the East Coast? Why don't you fly? It's because I wanted to see everything. And I think more and more people are doing that. Travel Centers of America are already a big deal when it comes to repairing trucks. And as they fix their properties up to add more food locations and a wider range of fueling options, I mean, it's going to be very easy for them to put up their own solar and have quick chargers, where you park your car for 20 to 40 minutes, you eat, and then you come out and your charge is 80% charged, right? You don't need those on every corner. You just need them every 200 or 300 miles. Travel Center America is very well positioned. There's a reason why Warren Buffett bought two similar companies. Twitter, I think, is going to continue to be important. I like the way the company is run, and I think that ultimately their media presence is going to rival many of the more traditional media players out there in terms of sports, access to your other subscriptions through Twitter login. I just think that they have, I think that they might create a tool for importing and separating, but importing a Facebook profile, right? Where you can check some boxes and say, yeah, I want to bring over the pictures, but only these pictures. I want to bring over the friends, but only these friends. Or I want to search my friends that have a Twitter handle. I think Twitter is going to probably compete with Facebook on like the other half of their platform, which doesn't exist yet, but I think it's coming. Facebook clearly needs a competitor. Ulta, Dave Zanoni pointed this one out, and this is a company I've talked about in the past. My daughter worked there at one point. Beauty is something just like these Fibonacci ratios happen over and over. Everybody likes pretty. Everybody looks like symmetric. Everybody looks likes looks. Ulta's not going away. They're a great company run by a great team of women. And I think that they probably do very well because their stores are the right types of stores. You know, parts of big strip malls, you know, where they box together 4 different stores. Entrance to the outside. I just think that they're set up in a way that their overhead is low relative to what they do. And their business is pretty sturdy. So if you can buy them on the dips, which we're getting now because everybody's throwing money at biotech, that is something to keep in mind. There's a lot of people throwing money at biotech and tech right now, and it's too much. So we can get value on companies like Ulta right now. Workday and Zendesk, I just think that they are really set up well for the future. Zendesk in particular. So, you know, as we go more and more online, companies like this will do well. And because they're not always favored, right? These guys have some black marks in the past. They haven't soared as much as other companies could. So these are your stocks. I'll have the buy zones in here by the end of the day, and most of them are done already. And all the charts will be in the VSL. You know, we're getting more and more. So why don't we take a couple of questions? Did I skip right over Micron? Yeah, Micron, I tell you what, I think Micron, you want to buy them on the pullbacks. We should have bought them in the 30s. But, you know, I think we can safely say that this is, you know, they're part of an oligopoly. I haven't done a chart on these guys in a while, clearly. I don't care about this back here. I care about the last 5 years, maybe a little bit longer. Maybe a little longer. So you have Brave New World of smart everything, tax breaks and whatnot. Peaked up here. I'm going to just call this normal volatility. Look at that, stops right at a 618. Right? It's crazy, right? Why? Why did it stop right at a 618? You tell me. Oops. Let's fix this line. There you go. Blue line, second shorter time frame. And then the extension. What line did it stop at there? A 0.5. You know, but that was 2 Fibonacci lines that were right there. I don't get it. I don't know why it happens. I just know that it does. So where do we want to buy Micron? That trend is clearly up, but with wild volatility. I think right around the 200-week average, so in the 40s, I think we probably want to be buyers. From this 0.5, you know, and maybe things get hairy, right? I mean, could it go all the way down here? It could. Why? Because it's a freaking semiconductor stock. And these things run in pretty big cycles. So from, I'd say 44-ish to 29-ish, that's your buy zone. If the world is getting better, I think you buy it near the top. And if the world's still getting worse and it still keeps going down, you buy it near the bottom. Keep an eye on these. We already have a negative divergence in the Chaikin money flow. Usually within 3 weeks to 4 weeks, price follows. Right? Never quite got overbought, so it could keep rallying short term. So the next 3 to 4 weeks, right? That's the hardest time frame. But I would say that with Chaikin money flow showing so many negative divergences, heading down while prices stable or rising, I'd say in the next few weeks is when you start seeing a lot of turbulence in the market. There's been some today already. I haven't even looked at the prices since the open. But you know, yesterday was a rally and it gave part of it back. Today we're down a little bit. And a lot of it has to do with the 401k money. Tell you what, if people's unemployment get cut from $950 a week down to $550 a week, it's going to be a big deal. And there's been study after study. There's really no evidence to support that people aren't going back to work because they make too much on unemployment. I mean, there's a handful of people. You know, it's some very, very low double-digit numbers, like 13 or 14%. Ted Cruz said something stupid on air on Sunday, but yeah, I mean, 1 out of 6 people, maybe 1 out of 7 people could go back to work and make a little bit more than they're on unemployment. So should unemployment be cut to get those people back to work at the expense of having other people who were making 50, 60, 70, 80, 100 grand, having the cash in 401ks cover their mortgage because they had been doing everything right? I mean, they want to punish people at the low end, and it's going to end up punishing people in the middle. So keep an eye on the unemployment benefits. If they come down more than maybe $100 or $200 a week, you know, $200 a week reduction is $800 a month. That's a lot of people's rent, a lot of people's mortgages, or at least half their mortgage. So, you know, a lot of these charts are either going to go to here and then extend back up, or they're going to go boom, 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 right? Make a little zigzag and head down to the bottom of these ranges. You're going to have to decide what you want to do. But this business in particular is an oligopoly. And people think of it as cyclical more than they should. It's not quite as cyclical as it used to be. And they have competitive advantage over everybody in the industry. I mean, it's them, Samsung, and Hynix, somebody. I forget who the third company is. But for DRAM, I mean, these are the guys. And they've got the new chip that's important. It's kind of a hybrid chip. This market just keeps getting tighter and tighter as we go more and more online. So I think you buy the pullback, you know, sell a lot of puts because you get a lot of premium, and then off to the races. All right, let's tie this one up because it took a long time already. And let's move on to the dividends.